Hey there, friend. Welcome aboard this exciting yet often puzzling adventure inside the stock market universe. Right now, we are diving deep into the key stock market concepts that actually make a real difference in how you think about investing. Relax, though, because we will break everything down in the easiest and most enjoyable way possible. Say hello to John our Bold Guide, navigating the vast territory of stocks with curiosity and courage. When we finish this together, you will grasp the insights that experienced traders rely on, and you might even drop some impressive market talk at your next gathering with friends. Before we begin, let me share a quick but important note. I am not here to offer any personal financial recommendations. Think of me simply as your helpful companion, your storyteller, and your enthusiastic John supporter, guiding you safely through this intricate landscape. All right, let us dive right in. So, what exactly is a stock when you get down to it? Essentially, it means you own a small portion of an actual business, similar to grabbing one piece of a growing pie that might expand beautifully or sometimes shrink unexpectedly. There are primarily two categories to know about: common shares and preferred shares. Common shares represent what the majority of everyday people purchase, giving you rights to a share of future profits along with voting power on major company choices, though those profit payouts called dividends are never promised. Preferred shares, on the flip side, rarely include voting rights, but they tend to deliver more consistent dividends and often place you ahead in line when the company distributes funds to owners. Most people building wealth never settle for just that single piece. Instead, they carefully construct an entire portfolio, which is a thoughtfully blended collection of various investments. Certain stocks regularly distribute dividends, acting like a nice bonus payment drawn straight from the business earnings. Companies that trade openly register their shares on public exchanges, making them accessible for purchase by almost anyone. Private businesses operate differently, with ownership typically staying within the circle of founders, early team members, or select private backers. Keep in mind that holding stocks brings real thrill and energy, yet nothing beats the hilarious expression on John face whenever those prices start swinging wildly in either direction. At its core, the stock market functions as one enormous trading ground, where instead of everyday goods, folks are exchanging pieces of ownership in real companies. Hearing that the market finished higher usually signals that the bulk of stocks have climbed in value. When it closes lower, you can picture John Portfolio resembling one very bumpy, disappointing ride. Truthfully, though, the stock market has never been confined to one physical location. It operates as an interconnected web of trading platforms where purchases and sales occur around the clock. Among the largest and most influential are the New York Stock Exchange, known as NYSE, and the NASDAQ. The NYSE feels like a classic bustling trading floor, packed with professional screens and lively calls across the room. NASDAQ, by contrast, runs completely electronically, offering speed, efficiency, and modern appeal, while serving as headquarters for major technology leaders such as Apple and Microsoft. What drives price changes comes down to basic supply meeting demand, to stronger buyer interest, pushes values upward, while waves of selling pressure send them downward. This constant activity explains why markets rarely stay still for long. They mirror human feelings and psychology just as much as cold, hard numbers and facts. Through his adventures, John quickly discovers that the stock market is powered less by steady resources and more by waves of fear of missing out, combined with sudden moments of widespread worry. To bring order to all this apparent disorder, many investors turn to indexes, which are carefully chosen collections of stocks designed to mirror specific slices of the overall market. Picture them as helpful scorecards that reveal the general health and direction of that market segment. Take the S&P 500, for instance, which follows the performance of 500 leading American corporations. The Dow Jones Industrial Average narrows its focus to only 30 prominent established firms. Then there is the NASDAQ Composite, heavily weighted toward technology names, delivering speed excitement and noticeable ups and downs. These indexes serve as important reference points, allowing you to evaluate how well your own holdings are performing relative to the broader scene. Imagine John Portfolio rising 5% while the S&P 500 advances 10%. In that case, he has not truly outperformed the market even if he feels like celebrating. Beyond personal tracking indexes, also guide professional fund managers and exchange traded funds in deciding which assets to follow. So the next time news reports mention the market declining, remember they are usually referring to the movement of these key indexes. Now, for two of the most colorful characters in the entire financial world, when share prices keep climbing and confidence spreads widely, we describe the environment as a bull market. The bull symbol charges ahead with energy and positive outlook. Conversely, when values decline and anxiety spreads, it becomes known as a bear market. The bear pushes prices lower with determined force. Joance attempted to challenge the bear directly, and let us just say, the outcome favored the bear. The important lesson here is that markets naturally follow repeating patterns of growth, decline, recovery, and renewal. This cycle represents completely normal behavior. A strong bull phase can extend across several years, while bear periods might resolve within months. Wise participants ready themselves mentally and strategically for both situations rather than reacting with fear during every dip. Those sudden price swings, known as volatility, form an unavoidable element of the entire experience. So, whenever you catch John gripping a soaring rocket on one day and clutching an umbrella the next, he is simply living through the same emotional journey that every investor eventually faces. Not every business opens its doors for general public investment. A public company makes its shares available on official exchanges, meaning practically anyone, including our friend John, can purchase ownership. Consider familiar names like Apple, Coca-Cola, or Tesla, where buying even one share lets you claim a microscopic stake in their operations. Private companies, however, guard their ownership, closely keeping shares among founders, staff, or specialized investors. Joance attempted to slip into one such private gathering only to be politely escorted out by security. The process of becoming public through an initial public offering or IPO marks a major milestone for any business. It brings celebration, spotlight, and excitement, but also introduces stricter oversight, greater openness, and constant public scrutiny. The stock market goes far beyond just businesses and individual buyers. It thrives as a dynamic environment populated by many distinct participants. Retail investors like John represent everyday people making modest sized transactions. Institutional investors, on the other hand, include powerful entities such as large banks, retirement funds, and professional mutual funds. Their sizable trades can noticeably influence overall market direction with just one move. Brokers play a vital connecting role, linking those who want to buy with those ready to sell. In earlier times, John would need to phone his broker for any transaction. These days, a quick swipe on a smartphone completes the deal instantly. Market makers further support smooth activity by ensuring enough available shares for trades to flow without major friction. Regulators from the Securities and Exchange Commission act as the watchful guardians preventing unfair practices. Without their oversight, the entire system could descend into unchecked disorder, leaving John vulnerable to frequent mishaps. Executing a stock transaction occurs through specific order types. The two primary varieties include market orders, which complete immediately at the prevailing price, and limit orders, which only activate once your preferred price level appears. One prioritizes quick execution while the other emphasizes precision and preferred pricing. John favors having that extra measure of control, yet somehow his chosen limits often end up slightly too conservative. Every stock carries a unique ticker symbol consisting of compact abbreviations such as AAPL for Apple or TSLA for Tesla. Trading activity also depends heavily on volume, representing the quantity of shares changing hands, and on liquidity, indicating how readily those shares can be bought or sold without major price disruption. When all transactions occur via the exchange matching system using bid prices from potential buyers and ask prices from sellers. The difference between those two figures creates what we call the spread. Jawance humorously tried bargaining over that spread only to learn it does not work that way. Whenever a company generates earnings, it faces a strategic choice between channeling those funds back into growth opportunities or returning a portion directly to its owners. That returned portion arrives as a dividend functioning like an appreciative payment accompanied by actual cash. Certain businesses maintain steady dividend schedules, while others prefer reinvesting everything to fuel future expansion. Earnings per share, or EPS, provides another crucial measurement showing the profit generated for each individual share outstanding. Elevated EPS frequently signals a robust underlying business, although occasionally such figures result from overly optimistic accounting practices. John attempted to figure out EPS calculations by hand on whatever paper was nearby, and the results proved less than accurate. Quarterly earnings announcements draw intense attention from the investing community because they can trigger rapid price reactions. Surpassing analyst forecasts often lifts share values sharply, while falling short can send them tumbling. Together, dividends and earnings reports paint a clearer picture of genuine company strength, helping distinguish truly solid operations from those merely putting on a convincing show. With a solid grasp of basic stock concepts, Jono turns attention toward evaluating whether any particular stock represents good value. This brings us into the realm of valuation metrics, which provide the numerical framework for making sense of market pricing. CAPE. One widely followed measure is the price to earnings ratio, or POS, which reveals how much investors currently pay for every dollar of company profit. An elevated PS might indicate either an expensive valuation or strong expectations for substantial future expansion. A lower PS could point to an attractive opportunity or alternatively signal underlying concerns. Jawance jumped on what appeared to be a bargain based on a modest PDS, only to discover later that the low price reflected genuine challenges. Another useful gauge is the price to book ratio, comparing current market valuation against the recorded value of company assets. It offers a reality check similar to inspecting whether the listed price truly matches the actual substance beneath the surface. Dividend yield measures the annual income received from dividends relative to the current share price. John playfully refers to this as his personal snack indicator, where modest yields feel like a light bite and generous ones resemble a full, satisfying meal. Of course, if the business faces serious difficulties, that high yield might simply represent a final payout before trouble deepens. Having explored valuation tools, John next examines market capitalization, often shortened to market cap. This figure multiplies the current share price by the total number of shares in existence. Major corporations like Apple command enormous market caps, placing them among the towering structures of the financial landscape. Smaller firms resemble modest neighborhood spots, offering charm and potential, yet remaining sensitive to even minor setbacks. Participants commonly categorize companies according to size into large cap, mid cap, and small cap groups. Large cap names generally deliver greater stability. Mid cap companies often show consistent expansion potential. Small cap stocks deliver higher excitement and bigger dreams, though accompanied by greater uncertainty. Jawance loaded his holdings exclusively with small cap names chasing dramatic upside. The journey proved memorable, but headed sharply lower than expected. Awareness of market cap allows for smarter allocation, balancing reliable larger players with smaller ones that could deliver pleasant surprises under the right conditions. Volatility comes next, representing the market tendency toward dramatic shifts in sentiment. It measures the intensity of price movements, both upward and downward, Calm periods alternate with stretches of intense activity. Technology-oriented stocks frequently behave like thrilling roller coasters, while utility companies tend to move more gently like peaceful flowing streams. John believed he could manage those fluctuations comfortably until his own holdings began performing unexpected acrobatics. That moment illustrated volatility perfectly in real time. Many traders monitor the VIX index, popularly called the fear gauge. Levels indicate widespread nervousness across the market, while lower readings suggest greater calm. Developing comfort with volatility encourages John to maintain composure, avoiding impulsive sales during downturns or excessive enthusiasm during rallies. In investing, emotional discipline frequently proves more rewarding than selecting the perfect individual stock. If volatility resembles the wild ride, then diversification functions as the essential safety harness. This strategy involves distributing capital across multiple businesses, industries, or asset classes so that problems in one area do not devastate the entire position. The complete set of your holdings forms your portfolio. Some investors blend stocks with bonds, exchange traded funds, and even precious metals. Others concentrate heavily within a single sector, hoping for the best outcome. Once placed his entire stake behind one promising technology name. When that position declined sharply, he realized that even the most promising concept benefits from having supporting options. A well-diversified collection tends to moderate extreme movements. Declines in certain areas can be offset by gains elsewhere, preserving overall equilibrium. This approach represents more than clever planning. It becomes essential for long-term endurance. Diversification helps keep John Holdings intact and his stress levels comfortably in check. While some enthusiasts enjoy selecting specific individual stocks, John tried that path and found the experience quite aging. He later discovered the relaxed advantages of index funds and exchange traded funds. Rather than owning shares in one single business, you gain exposure to a broad range of many companies through one investment. An index fund mirrors a chosen benchmark, such as the S&P 500, providing participation in hundreds of leading firms simultaneously. ETFs operate similarly yet trade throughout the day just like ordinary stocks. Both options deliver simplicity, broad coverage, and reasonable costs, making them especially suitable for patient, long-term oriented investors who prefer avoiding constant market monitoring. John affectionately labels this approach smart, relaxed investing. He simply establishes the position, then steps away, allowing broader market forces to handle the work, while he relaxes with a cup of coffee instead of refreshing price screens constantly. To round out our exploration, we should address two contrasting categories: blue chip stocks and penny stocks. Blue chips belong to well-established, respected companies with long histories of reliable performance. Names such as Coca-Cola, Apple, or Johnson& and Johnson come to mind. They typically maintain steady dividend payments and rarely cause sudden alarm when you review account statements. Penny stocks exist at the opposite end of the spectrum, operating in a more unpredictable environment. These involve smaller emerging companies whose shares trade at very low prices while offering ambitious growth narratives. Although occasional success stories appear, most tend to lose momentum quickly. Jawance acquired several hoping for rapid riches. He now describes them lightheartedly as disguised lottery entries. Blue chips contribute steadiness and consistency. Penny stocks inject thrill and possibility. John continues refining his approach by blending both, recognizing that effective investing requires knowing when caution serves best and when a measured amount of boldness makes sense. Every form of investing carries inherent risk. Without some element of risk, meaningful returns become unlikely. That principle remains fundamental. Excessive risk, however, feels more like leaping from a high financial precipice. Jawance pursued the trending stock everyone was discussing. It appeared unstoppable right until momentum reversed. He now understands that greater upside potential usually accompanies elevated chances of disappointment. This realization highlights why patience delivers such powerful advantages. Markets tend to favor those who preserve composure, while surrounding sentiment turns fearful. John previously monitored prices almost hourly. Today, he limits checks to roughly once per month and enjoys noticeably improved rest. Over extended periods, the most significant advantage comes not from perfectly predicting short term movements, but from remaining invested through changing conditions. Jin ultimately recognized that successful investing resembles less of a quick dash and more of an endurance journey featuring occasional challenging sections. That concludes our tour alongside John through essential investing territory. From navigating intense price swings to embracing thoughtful spreading of risk, he has come to appreciate how index funds can protect peace of mind, while occasional speculative positions can challenge resolve. No matter whether focusing on established blue chips, utilizing exchange traded funds, or simply mastering personal reactions, the foundation always returns to maintaining equilibrium and cultivating steady patience. If this discussion helped clarify some concepts for you, please show your support with a positive response. Consider joining for future straightforward explanations on financial topics presented visually. Share in the comments below which particular stock market idea resonated most strongly with you today. Thank you sincerely for spending this time with us. And always remember to remain eager to learn, keep a patient perspective, and never allow Jonto make trading decisions while feelings run high.